Dalio tends to say like you can have 16 uncorrelated return streams. That's just categorically untrue. Stop thinking about your savings as investments. That's where I think the industry's lied to all of us. Is everybody thinks I'm going to put this money away and I'm going to get rich off of it, so then I can retire to a beach somewhere. These are your savings. You need there to be when they need them most and to outpace inflation. I'm going to talk you about the greatest basketball player of all time from the Chicago Bulls. And everybody's like, Michael Jordan. I'm like, nope, Dennis Rodman. I'd love to believe in American exceptionalism, but I can't help the little voice in the back of my head going, we're not that special. If it can happen anywhere, it can also happen to us.
So, Matt, I think this is an episode that maybe all of us, given what's been going on in the market in the last few years, we might desperately need right now.
I think the world needs a hero, and that's what we're here to provide them with.
Yeah, I think we're all starting to feel like maybe, if I've got my Trump coin and I want to diversify that, I probably add the 2X MicroStrategy ETF. And then if I really want to get crazy with the diversification, maybe I throw some NVIDIA in there, and then I'm in pretty good shape. And it turns out that might not be the reality of the situation.
This is the way, right? This is the new diversification is like how many cryptocurrencies, meme stocks, and potential, political shill companies, shill shells do you own? That's really the way this feels right now. And it's pretty unnerving for people who take a, I guess, more traditional or boring approach.
Yeah, and we're going to talk about Jason Buck today, and Jason's like at the absolute other end of the spectrum. He's really thinking about building a completely diversified portfolio for everything that could possibly happen in the world, not just what's happened in the past 40 years, not just what happened in the past 2 years with all the meme coins and everything, but thinking about a portfolio that's truly diversified, across any type of regime. And I think that's really a good thing for all of us to talk about right now, because we're kind of in a world where maybe that type of thing has not been, on the front burner for people.
Not only has it not been on the front burner, let's be honest, it's been a few years since we've had real volatility. And that was why I was so excited when you said, let's do the clips for this one. That's why I went deep back in the excess returns library, not just you went back and got the clips. I went and got, and a lot of people don't know this, they know Jason from the Pirates of Finance stuff and understanding, capturing booty on the seas of markets or whatever that was about. I went and got his original book that nobody talks about. And I mean, I've read the hell out of this book. Did you ever read this? Iceberg Buck, the story of my life, Pimp of Vol.
I did not, I didn't know that was a thing.
This is Jason's first book. I thought I could use some quotes from this when we go through these clips to explain why this is so important.
I think he's going to love that you're going to pull those clips out.
His words, not mine, Jack.
So let's get started here before you get too lost here. But one of the concepts, this is from our interview with him, and he's come on twice. He's done a Show Us Your Portfolio episode where we talked about how he manages his personal money, and then he came back on and talked to me about his overall philosophy. But one of the things that was in both of them, and I think it's a really interesting concept, and he does a really good job of articulating this, is the idea of offense versus defense in a portfolio. So here's Jason talking about that.
Yeah, I'll start with, Dalio tends to say like you can have 16 uncorrelated return streams. That's just categorically untrue. There's really only 3 correlations, right? There's correlated to stocks, there's uncorrelated, negatively correlated. And correlated stocks is what we're talking about with stocks and bonds is, when people say correlations go to 1, that's in a liquidity event. When March 2020 happens, all of your assets sell off at once, and that's why we call them all offensive assets. Typically, when your financial advisor or your portfolio, whoever constructs your portfolio for you, will show you this pie chart of this broad diversification. But when we try to show people that pie chart, it's usually 99 to 100% in offensive assets. In a March 2020 scenario, they're all going down together. So right there, that's your problem is most asset classes are, like I said, long GDP, short volatility, or they're correlated to stocks. They're offensive assets. So that's part of the correlations. The uncorrelated portfolio that you typically have is the commodity trend advisors. So trend following on the universe of commodities is by definition of the strategy, it tends to be uncorrelated, which can be, positively correlated, negatively correlated, half and half. And then you have structural negative correlations that you can get with long volatility and tail risk products, right? If I buy a put on the S&P 500, that gives me a structurally negatively correlated product to the S&P 500. So one, people aren't thinking about their correlations. So at a gross level, we try to think about, we have half for offensive assets, half for defensive assets. We think about the 3 correlations. Then we overlay that 4-quadrant model. And then part of the 4-quadrant model that we think if Harry Brown were alive today, instead of cash is pretty inert, right? Which is great. Cash did really well in, 2020, 2022. But the idea is, in a more financialized universe, that drawdown can be so severe on stocks. We like to balance that out with long volatility tail risk. To us, it's more like a convex cash position that really helps offset that linear position of stocks. And then bonds, like we said, is a linear position for a deflationary or disinflationary environment. We like to offset those with our commodity trend advisors just by the structure of the way they create the trade. It ends up being a convex trade as well. So you're offsetting that linear position with convexity as well.
Well, first of all, Matt, I was promised 15 uncorrelated return streams. And it appears as Jason is telling me I'm not going to get my 15 uncorrelated return streams.
When he calls Ray Dalio chicken nuggets boy, I mean, I understand now why he's got to take this shot. And I don't blame him. Allow me, before we dig into these uncorrelated return streams, just one quote from the bestseller Pimp of Vol. He actually says in the book here, a volatility pimp is happy when he hears his long-only investments giggle. He knows they are still asleep. This whole correlated versus negatively correlated versus uncorrelated to stocks thing, this is such an important concept. How do you think about this? Like, this makes my brain so happy as an allocator to hear this conversation.
Yeah, we're also thinking about, when we think about uncorrelated assets, a lot of people maybe think about stocks and bonds. And, that's really what Jason adds to this is that's not enough. And when we learned that in 2022, it's not just I need my stocks and my bonds and I've got my uncorrelated assets and I'm good for any type of environment that could possibly happen. There's a lot of other different types of environments that can happen, as we saw in 2022. So I think that's really important, is to think about, if you think about offense stocks, defense bonds, you're not thinking about the whole picture.
Yeah, you can't just talk about zigs and zags in this stuff. You have to zoom out. You have to see some other options. And I love this idea of actually understanding this at these three levels. If you understand these three levels, if you understand the 4-quadrant approach they take at Mutiny Funds, it's a really useful structure to get yourself away from just being levered long GDP, which is what so many of these traditionally designed portfolios are geared to do.
Yeah, and I hopefully Dalio is going to tell me at some point what the 15 uncorrelated return streams are, because I still feel like maybe behind the scenes, he just got those things and he just hasn't revealed them.
Yeah, it's a secret. I don't think it was in Principles, but that's why this is a better book than Principles to me, honestly, in so many ways.
I'm sure it'll sell just as many copies.
For sure it has.
Yeah. So moving on here. This was actually at the end of our episode on Jason's portfolio. We always ask this question. What's the one lesson you would teach the average investor? And Jason talked about this idea of investing versus saving.
It's tough for me. I hate giving advice because I don't listen to any myself, and I don't really think I have any. But I always like to watch what people do, not what they say, and that's why I was happy to be on here to talk about what we do, because that's how I view the world. The one piece of advice I give, or I would think about, is that stop thinking about your savings as investments. That's where I think the industry's lied to all of us, is everybody thinks I'm going to put this money away and I'm going to get rich off of it so then I can retire to a beach somewhere. These are your savings. You need there to be when they need them most and to outpace inflation. As soon as you start thinking about a way to get risk, you're going to take imprudent risks and you're likely going to lose most of them, or they can be underwater for decades. So the only way to get rich is in your business, your job, whatever you want to do, but your savings need to be as robust as possible so they'll be there when you need them most.
So I love this idea of thinking about your portfolio as savings. If you think about your portfolio as investing, which is important to think about it that way as well, but you maybe tend to take too much risk, or you tend to think about like my goal here is to get rich with my portfolio. And when you start thinking about my goal is to get rich with my portfolio, which I think a lot of people are thinking about today, you can end up getting yourself into some trouble.
One of my favorite quotes from the book here is, an emotional debt is hard to square. And I think this fits into this idea of thinking about protecting your savings. An emotional debt is hard to square, because if you are borrowing against future emotions, if you're borrowing against the expected, look at all the returns I'm going to get from this crypto bet, or look at all the returns I'm going to get from this portfolio. I'm just Monte Carloing it out into the future and putting myself emotionally tied to all this money I'm going to have. You're forgetting to tie it back to the logical reality of what is this money for? That's such a financial planning concept. That's such a thing I talk about all the time in my own day-to-day work, where it's, what is this thing actually for? Because you really should separate the money you do need to spend on something that you've already identified from your job or your investments or your stuff that you hope to go up at a rate faster than inflation. Does that like separation cross into your work at all?
Yeah, and I think the idea of separating it from your job is so important, because the formula that works for most people is get rich from my job, protect and grow the wealth with my portfolio. And sometimes people get that backwards. They think I'm not going to get rich from my job, but I'm going to put the money in this crazy meme coin or something, and I'm going to get rich in my portfolio. It does work sometimes. And when we see it work, all of us think we can do it. When we see the person who bought NVIDIA, whatever, 10 years ago and has just made a massive killing, we think all of us can do it. But the reality is most of us can't do that. And the odds are much more in your favor with the get rich with my job, protect and grow with my portfolio.
An emotional debt is hard to square. You just got to keep repeating that to yourself, because if you allow yourself to get into those emotional debts of chasing those dreams, or I love that example too. I see this all the time talking to people. My job's not going to get me rich. So I need a lottery ticket. That is a dangerous debt to put yourself in servitude to.
So sometimes this idea of thinking about uncorrelated assets or thinking about your portfolio as a team that works together can be hard for people to get. And I think one way you can relate it is if you relate it to sports, people might understand it better. And so he had two examples in the interview of this. One is talking about Dennis Rodman, and one is talking about Herschel Walker and when the Dallas Cowboys traded him. So both of these examples, I think, help to illustrate these points.
I was actually talking about that recently, and I was like, I'm going to talk about the greatest basketball player of all time from the Chicago Bulls. And everybody's like, Michael Jordan. I'm like, nope, Dennis Rodman. Because Dennis Rodman's the lowest scoring player ever to be in the Hall of Fame. But at his height, he was 6 standard deviations better than any other defensive rebounder in the league. And so he ranks number 1 for the highest efficiency of points differential percentage when he's in the game versus out of the game. Because if you think about it, he was able to garner, 17% of offensive rebounds, and he's kicking that back to Michael Jordan, Scottie Pippen, Steve Kerr, or Paxson. And that's what's increasing the offensive efficiency of the team. But we always are enamored by these high scoring players like a Michael Jordan. And we're not thinking about the defense or the rebounding that helps us as the ensemble of the team to eventually win championships. Like, our moniker for our firm is offense wins game, but defense wins investing championships. And I think people really understand that in sports, and that's why I love sports analogies, but they tend to forget about it in their portfolios when they tend to hold all offensive assets. And when correlations go to 1 in a liquidity event, they all go down together. So what's interesting is Herschel Walker was drafted to the Dallas Cowboys in 1985. And over his lifetime, Herschel Walker was a Hall of Fame player. He had over 8,000 rushing yards, 61 touchdowns, and almost 5,000 receiving yards at a time when running backs weren't receivers. So he was really a multi-tool player, a really diverse threat. And in 1989, the Minnesota Vikings decided they had to have Herschel Walker. That was going to be their missing piece to win a Super Bowl. And in that time, in 1989, I believe the Dallas Cowboys went 1-12. So Herschel Walker was by far their best player. So why would you get rid of your best player? They decided to do a trade with the Minnesota Vikings that eventually was 3 draft picks and an additional 5 players. So essentially 8 players for one Herschel Walker, for one great trade. What's interesting, actually, you can watch a documentary of this on 30 for 30, but actually the Jimmy Johnson and the Dallas Cowboys, they traded their way from like that 3 draft picks and 5 players. It ended up being like an 18-player trade when they got said and done with San Diego and everything else. I mean, it's just a crazy story overall. But in the end, Dallas Cowboys used all those draft picks to go out and get people like Emmitt Smith, Darren Woodson, and build a team approach. And over the 1990s, the Dallas Cowboys end up winning 3 Super Bowls in the early 90s, and that's how they became America's team. Meanwhile, Herschel Walker was kind of a bust for the Minnesota Vikings, got traded later to other teams. And so what we try to use this as an example of, the Minnesota Vikings were thinking about the one great trade, while the Dallas Cowboys were thinking about a team approach or the ensemble approach. And that's what helped them to win championships. And it was eventually called the Great Train Robbery, because that's what Jimmy Johnson bragged to reporters, is that for one player, he ended up, parlaying that into 18 different trades. So it was the Great Train Robbery. And that's why it's known as both the Herschel Walker trade and the Great Train Robbery. And like I said, there's a great documentary on 30 for 30 about it on ESPN. But this is why we always like to think about an ensemble approach and a portfolio construction approach versus a singular trade. And I think most people think about their investings or savings as an individual, as singular trades, whether that's the S&P 500 index or if they're a stock picker, and they're not necessarily thinking about the portfolio construction of their team.
Yeah, the Rodman one is a really good one because Rodman, at the time, everybody knew Rodman was a crazy good rebounder, but at the time, Rodman was not appreciated because we didn't have the advanced analytics. He was not appreciated for what he was, which is one of the best basketball players of all time. And the reason he was one of the best basketball players of all time is everything he did made everyone else around him better. And so if you can get things in your portfolio that are like that make the other things in your portfolio better, that's a huge accomplishment.
Who wrote that Rodman paper? I didn't look it up beforehand. I was too enamored by going through quotes of this book. Who wrote the original Rodman as the ultimate? Do you know what I'm talking about? We can edit this part out. Okay, this comes from, there's a finance paper from like 2016 one of basically like the long tail strategy guys writes this. And it was one of
Okay.
those, it's an amazing paper. We'll find the link and we'll give a proper accreditation for it. I think of this too is you have to be exposed to this type of thinking. You have to come into it. Young Jason, and he says this in the book, no more small towns for me. I was going to the city to get my degree in volatility pimping. And when he said that, he's talking about everybody's looking at the big city. You're looking what everybody knows about the Michael Jordans and the people who put up the numbers. Nobody's talking about the systems that service those people. What are the systems that service the Michael Jordans of the world to get them to play at that level, to play at that game? And this is a critical step to understand the infrastructure around them, because nobody's doing this alone. And that stat that he gives about what Rodman does on the field versus, or on the court versus off the court, the differential in points scored when he's there getting rebounds, like that's a mind-blowing way to think about the team as an ensemble, the team as a system. I love this, especially applied at the portfolio level.
When I think about it with a portfolio, I might think about something like managed futures. So if I have managed futures, one of the good things about managed futures, like if you add it to a portfolio, is it tends to do very well when everything else is doing badly. And so if you added managed futures to a portfolio, what does it allow me to do? It's basically like rebounding, and it allows me to put money into my stocks when the stocks are down, because it's up when the stocks are down. So it's creating a better team for me by having it on there. Now, there's going to be times I'm going to look at my managed futures and be like, why isn't it scoring any points here? Michael Jordan is scoring points. Why isn't this not? But if you think about it in a team, from a team concept, and you think about it from an overall portfolio concept, it adds a ton of value. I think it's very similar to the Rodman thing.
Yeah, rebalancing and rebounding, right? Like that's what we're talking about. We have these things, rebalancing and rebounding go hand in hand. And the more thoughtful you are about what are great assets to have as part of your ensemble to help with your rebalancing strategy, that's how you win championships, right?
And the Herschel Walker one is good too, because everyone wants to have the star player, and they also want to have the star thing in their portfolio. Like I saw this stat, and to be honest, I haven't even followed what happened to the Trump coin since then, but like the Trump coin from like Friday to Sunday in the weekend it came out produced the same return the market had produced since the 1970s. So you either could have invested in the S&P 500 since the 1970s, or you could have spent 48 hours investing in the Trump coin and you made the same money. So, but people get drawn to that. They want to see this thing and be like, this is the star of my portfolio and it's going to drive all my returns. And then you put way too much money in that thing and then it doesn't work out. And so I think that's a good example with Herschel Walker is the Minnesota Vikings overstated what Herschel Walker was. He was a great player, but he wasn't an entire team by himself. And they overstated that. And that led to them making a mistake that the Dallas Cowboys turned into a bunch of championships.
Now, my minor footnote on Herschel Walker is that, like, if you really wanted to give a run with an underdog team in Tecmo Super Bowl, you could play as the Vikings and Herschel could get you some yardage. Like, he was a good player. But then my real secret weapon, Madden 94, the Eagles, we had Scramblin' Randall and Herschel Walker. That run offense combined with the pass ability, that was my great sleeper team. I could take the 94 Cowboys 9 times out of 10 on Madden 94, which I think is just a way, like, know your variables and know your game. That's really where this boils down to. All the respect to Herschel Walker.
I was a big Randall Cunningham fan. Like he was one of the original guys that the whole runner passer thing. He was one of the original guys that kind of revolutionized that whole thing.
Yeah. Scramblin' Randall, a god amongst men, lest ye forget young Jalen Hurts fans, let's say it.
So this next one I think is really important. And I think a lot of people miss it, which is this idea that everything is obviously quoted in nominal returns, but we also, and we've learned this in the past few years, we have to consider what we have left after inflation when we think about nominal returns. So here's Jason talking about real versus nominal.
I always just think about what's my net that I can eat at the end of the day, right? And so most people always talk about nominal returns. The two things that drive me nuts, they talk about nominal returns, and they're usually just talking about your annual arithmetic return, like each year. And they don't think about the time horizon in that we have to actually compound those returns in real life. And then they're just looking at the nominal return prior to inflation. But that inflation over time can be a pernicious drag on your portfolio. So if it's average 3%, et cetera, you have to subtract that out from your nominal returns to get your real return. Because what you really think about is, I think the industry has led us wrong in talking about our savings as investment. And it takes, unusual risk then with our savings, because then we think this investment should really grow over time. But what we really want our savings to do is outpace inflation and be there when we need them most. And so that's why we have to really think about real returns, of taking your nominal return minus inflation gives you the real return. And maybe we'll get into it later, but people love to debate what the inflation number is. I don't know, I don't necessarily want to get in that debate, but over a longer time horizon, let's just say it averages about 3% a year. So if, let's say, the stock market was compounding at like 10%, you have to minus that 3% out of there. There's a little more math to it, but that gives you the rough heuristic of about a 7% compounded growth rate over the last 100 years.
What's the thing people say, like you can't eat nominal returns, or something like that? I mean, it's the general idea that like I have to keep this in the right context. If my stock portfolio's producing this great return, but it's doing it in a period where inflation is ultra high, I don't have that much left. And so I just think, you're never going to see CNBC sitting like, here was the real market return for today or something like that, or nor could they even know what it is. But I do think when you look at longer term numbers, it is important to keep this in context.
So there's back to Pimp a Vol. There's a great story where he's talking about this long only investor who's always only focused on the nominal and the real. And in the book, the quote basically goes, "The vol pimp game is like the watchmaker's art. It's tough." Party, who's the character in the story, our nominal return guy, he went through his life struggling to make a watch while wearing boxing gloves. And that's really what you're doing. If you're only looking at nominal and you're not thinking about real, it's like trying to make a watch wearing boxing gloves. It's not going to cut it. You're sandbagging yourself to ignore the impacts of inflation. And it's such a critical step because back to the savings part of this too. If it's not just your investments where you always kind of get above that cost of inflation, you need your savings to grow at that rate too, because inflation is a cost. And if you're not making some forward assumption or some forward penalty against what you're doing, yeah, it's really going to hurt. And we're not talking about the price of eggs here. Like, it's going to hurt if you're not keeping up with that cost, because that's the way, a movie in my day cost, 5 cents and whatever, like those stories that you hear that we laugh about now, like those are still real numbers. You have to do stuff to keep up with this, or you're trying to make watches with boxing gloves. It's just not going to turn out well.
And it's hard when we just went through a period where it didn't matter that much, the difference between real and nominal returns, because inflation was kept at bay for such a long period of time. Like you sometimes forget about that. And, now you get into a period where it's a little bit higher and it's come down, but it's still higher than it has been. It's more of something to consider when inflation is an issue. And we were just very lucky that we had a very long period where it wasn't.
Yeah. And whenever you think forward, that's part of where it's almost like it's a mental insurance to build that into your forecast. You're not going to be right in your forecast, but always setting yourself up for that expectation that life is just going to cost a little bit more every single year. It's a good way to look forward. It reminds you that resistance is probably going to be there. And that makes it a little bit easier to cope with when you get ugly surprises like we've had in the last couple of years now.
So I thought this next step was good context, because one of the things, once you differentiate real versus nominal returns is, let's look at the assets we actually invest in, and let's look at what the long-term real returns of those assets actually are. So here's Jason talking about this.
So I think the rule of thumb I always like to use, because everybody unfortunately will use different bookends for their time horizons, right? Like you'll hear 100-year return, and that's really like 1916 to 2016, or or 1920 to 2020. And it's like everybody's using kind of different bookends, which gives you a little bit different numbers. But the easiest one to think about long term, I think Meb Faber's done great publications on this, and I think some of it comes from the Triumph of the Optimist. But over the long, whether you want to use 100 years, 120, 180 years that we'll talk about later, the idea is the real returns, the rough heuristic I use is stock market's about 6.5%. Let's call it 7%, because some of those windows will say 7%. So let's be optimistic. Let's say the real returns of the U.S. stock market are 7%. The real returns of global developed stock markets are about 5%. Interestingly enough, the 60-40 portfolio over the really long term is about 5% real. Commodity trend followers do about 4% real compounded. Bonds 2%, and bills are about 0.5 to 1% over time. So that's the kind of rough heuristics we use. As I think about it as like 7, 5, 4, 2, 1 gives you a rough idea.
So inside of that global number, there's a big amount of dispersion with all these other countries. So like, what did you find when you looked at that? Because one of the things I've always wanted to say in a podcast is now do Japan. And so this is your opportunity to now do Japan.
Yeah. So what we were looking at is, there's a great book by Jeremy Siegel called Stocks for the Long Run that is one of the best-selling books of all times in finance and investing. And more recently, Arnarkulova et al. In the Journal of Financial Economics did kind of a takedown of that paper. Not necessarily takedown, but they want to look at like developed economies globally going from 1841 to 2019. So there's like a 180-year study of kind of global stock markets and thinking, about real returns over those global stock markets, or even nominal returns. It doesn't really matter. But like you're pointing out, the dispersion, in using 30-year rolling windows, 1990 to 2020 for Japan is negative 20%, 1% real return total. So you had a 30-year period of being underwater in Japan. And it's interesting, like you said, that's usually the anomaly that people point to. And I wonder, we like to throw it out there as an anomaly because people don't want to deal with it. Like you said, now do Japan, and people's brains kind of break because they're like, well, it just doesn't, you can't count Japan. I always wonder why or how that happened. I really don't know the answer, other than I really wonder if I'm being compassionate towards my MMT friends. I wonder if that's the first time we really had that developed economy have that underwater period, post going off the fixed rate exchanges. And so maybe Japan is the leader. Maybe some of these other developed countries are going to see something that's, similar to that in the future. But then you're talking about what is the actual dispersion of those returns. If we look across global stock markets on real returns over like 30-year rolling windows, like the first percentile is a negative 94% return. And the top percentile, that 99th percentile, is a 70x. That's a massive dispersion in returns that gets you to an average of 7% CAGR on real terms. So like that's the kind of dispersion we're talking about, from negative 94 all the way up to 70x. And then what they tout in the media is that your average is 7% CAGR. And we'll get to this. Is like, are you likely to be average? I'm not so certain of that.
I thought what he said here is really good. Like if you look over really, really long periods of time, you say you've gotten 7 real from the US, 5 real from global stocks, 4 real from like trend following type strategies, 2 real from bonds. I mean, that at least gives you context. That gives you a framework to work from when you think about what the returns have been historically. Whether you think they're going to continue that way or not, at least that gives you a framework.
Do you think of like stocks versus diversified portfolio versus a commodity trend portfolio versus bonds? Do you think of all these asset classes of just like, obviously they must have some underlying risk premia if they exist?
Yeah, I mean, they have to have some sort of risk premium. But yeah, I think that's definitely true. And one of the interesting things is, how you think about how these vary over time. And especially as it relates to the U.S. stocks versus the global stocks, because, he gave the example 7 versus 5 for U.S. versus global, but there's not necessarily, we're going to get into this later, there's not necessarily a reason that has to persist, or there's not necessarily a reason I have to think I'm going to get, in the next 80 years, I'm going to get 7 from the U.S. and 5 from global. I might, but that's, this is one of those cases where relying on history can be a little bit tricky, because I may not, I can't put into my modeling, I'm going to get 2% more from the US than everything else and be 100% confident in it.
Yeah, choosing to take the risks and where you're going to take them, and then where you're going to extract the returns. I'm going to read another passage from this. This is advice he's getting from one of his mentors, young Jason Buck, Slim in the story here. So Slim Buck, I hope you ain't billed that pretty. I'm not going to swear. That's not an excess returns thing. I'm editing this. That pretty B yet. Believe me, Slim, a volatility pimp is really a long-only investor who's reversed the game on long-only investors. I'll say that again. A volatility pimp is really a long-only investor who's reversed the game on long-term investors. Slim, be as sweet as the scratch. Don't be no sweeter. Always stick a long-only investor for a bundle before you stick it. A long-only investor ain't nothing but a trick to a volatility pimp. Don't let him Georgia you. Always get your money in front, just like a long-only investor. Long-only funds and a stable are like working chumps in the financial industry's factory. You want to stack these things up. You want to understand how you run them like a stable, and then you got to make sure you get paid for the risk you're taking. And that's going to change and evolve over time, which back to the idea of thinking about this globally, back to thinking about this across asset classes, back to thinking about this across those 4 quadrants and how to actually be diversified. Brilliant lessons.
So this next clip gets at what I was talking about a little bit before, which is, we have this 100 years of data. And the question is, were there things in that 100 years that might not repeat in the future?
That's a shout out to you for like being a stocks for the long run guy and wanting to find a disconfirming bias, right? Like most people are always looking for that confirmation bias. And I'd love to be it's really hard to argue against stocks for the long run, because I feel like it's one of those scoreboard things. Like everybody just points to the last like 40, 50 years and it's like scoreboard. And you're like, you're the turd in the punch bowl at the parties, like pointing out what could potentially go wrong. So I understand why most people are stocks for the long run. And at a really high level, what I try to think about is, what can and could go wrong. And from a really high level, I think it really boils down to something very simple for me, is that, a lot of times you'll see, these stock charts that just go up and to the right for the last like 150 years in the US specifically. And I go, okay, what happened in the last 150 years? Well, we had the full advent of like the Industrial Revolution, and we went from about 1 billion people in the workforce to 5 billion people in the workforce. And the US has been the most dominant country in the world for the last 150 years. And I'm like, does that play out into the future? And you just look at population growth and statistics, it's not very likely. So what I always question is this a 150-year period, and then more specifically the last 40-year period that we'll get into, are these likely to continue on into the future? What can I learn from the past, and can I project that into the future? And I'm always, uncertain of my own biases there.
This is really hard. It's really even hard for like someone like me because I'm a data guy, I'm a factor guy. And like what we try to do is use the longest period we possibly can for, when we think about long-term returns. But it is very true. What's the Adam Butler thing? Like, I forget what it was, but there's the thing like more things can happen than will happen. And the idea is like the 100, even a period as long as 150 years could have played out differently than it did. And that's really hard to think about. But I mean, when you think about things like wars and, all the different things that can happen in the world, the next 150 years could look completely different than the previous 150 years. And that doesn't mean, you don't invest in stocks. It doesn't mean you're going to have a 0% return over 150 years in the stock market, because you're not. But it does mean that what worked better, US versus international, that could pivot. What types of things we saw on a global conflict stage could change. The way, and obviously the AI is a great example of this, because who knows how AI is going to play out right now. I mean, people are talking about like artificial general intelligence coming very soon. And like, what does that even mean for the world? We don't know. And so the whole point is, when you look at this history, it's very, very important to learn from it, but it's also very, very important to say, all right, this might not play out exactly the way even a period as long as 100 years did.
And I love the defense too of stocks for the long run, or the historical returns and the regression. As a data guy, when you pull up that set and you go, hard to argue with these numbers. And the reality is, and another quote, only a fool trips on what is behind them. Like, that's what happened. That is what's here. But if you're going to risk tripping over that because of all the stuff that went in to making those, and I love how he gives the example of the Industrial Revolution, of population growth, add the workforce evolution and all the stuff. Could that actually conceivably happen again? Will it unfold in the same way? Because all that stuff it's hard to unpack, but it is all tied to that return. So careful not to trip on the thing that's behind you.
Yeah, what's interesting is, and I'm not someone who knows a lot about this, but the people who do study demographics are somewhat worried that, the future may not look like the past. Some of the demographic trends, especially in the developed world right now, are not particularly great. So maybe that does change. I'm not calling for the coming apocalypse or something, although I might put that on the YouTube cover. But like maybe that does change a little bit about how we think about returns going forward.
I think it should, if nothing else, to help keep us honest as allocators, investors, and to help us think about investments versus savings, to use his language, or just to actually think about diversification when we're helping people with plans and to plan for a future where they're going to have real expenses. We're not just talking about the theoretical pots of money that you're never going to spend. This isn't like an endowment that never needs to pay anything out that's supposed to be here for a bajillion years. This is, your money, your allocations, your investments, and you're probably going to need some of it in the future. Understanding some of this stuff, listening to what he's saying, reading Peter Zion, paying a little bit of attention to some of the demographics people, but all the bright spots in the Fourth Turning books too are basically like, yeah, we go through some of this stuff and it's weird. Paying attention to this can at least help to, I think, humble us from blindly expecting the past just to repeat.
And that fourth turning point is important as well, because everybody uses that fourth turning as like the most negative thing of all time. Like, I feel like anytime like Neil is on any kind of podcast, it's like the fourth turning has arrived and like everything's going to fall apart. But that book is not like a completely negative book. It just maybe where we happen to be in the cycle right now might be bad. But like the book itself is not, an overly negative book.
I think, and especially in the latest edition, I loved The Fourth Turning is Here. I think it is a fascinating book for anybody in and around the finance industry who wants to think about this stuff and demographics. And I think my favorite part about that book and what's so positive about it is it basically says how generations lose the ability to talk to each other as we go through these cycles. And that's one of the big takeaways of where we are now, is you have all these generations saying different versions of the same thing and they can't connect. And that's what happens in that fourth turning, is like you start to have actual new leadership emerge, new ways to connect these generations so they can communicate with each other. Hey, I would take that right now. It's a pretty divided and messed up feeling world. I would love to think that more people could actually communicate with each other without, the coming apocalypse. But by all means, make that the YouTube cover.
Yeah, people will leave the video in about 3 minutes, though, when they realize we're not talking about the coming apocalypse.
That's okay, because they'll realize they'll all be on Amazon buying a copy of this book.
They'll just be so blown away by your use of that book that they'll stay here, even though that we're not giving them what they expect, I guess.
This is what I'm banking on.
So this next one gets at what I talked about a little bit at the beginning, which is this idea of U.S. exceptionalism. Obviously, things have gone very, very well for the U.S. relative to the rest of the world for a long time now. So the question is, can we expect that to continue? So here's Jason talking about this idea.
The other thing that a lot of people point out with like even 60-40 portfolios being underwater globally over like rolling 20-year windows too in real returns, like you see like even going back to 1990, you had Russia negative 100%, China negative 100%, Germany negative 100%. So it's not just Japan. And then the whole point is like, oh, people can go, okay, let's take out the First World War and Second World War because it's understanding how their economies, their stock markets got destroyed. You have more modern versions, even like Italy, 1960, 1980, negative 72% on a 60-40 portfolio. You know, similarly with India, negative 66%, Spain, negative 59%. So it at least broadens us out to not think only Japan's the anomaly. Like this has happened kind of globally across developed markets. So what do we have in American exceptionalism? Look, I'm born and raised in America. I've thankfully lived all over the world, but I mean, I'd love to believe in American exceptionalism, but I can't help the little voice in the back of my head going, you know, we're not that special. You know, if it can happen anywhere, it can also happen to us. And like you were referencing, you have, you know, you read your Peter's eye hand, right? We're surrounded by two massive oceans. We have unbelievable two weather patterns that create this, you know, breadbasket in the Midwest and upper Midwest. We have all these amazing things going for America that, and then obviously our innovation that we get out of Silicon Valley. And then now are we in a two-headed race on AI between the US and China, and Europe's kind of gone off of that race? We'll see. I mean, so there's a lot of reasons to be very strong and bullish the US. And I am, you know, like I'm an optimistic entrepreneur in the US. So I'm very happy if the US continues to outperform. But just looking at a historical perspective or the context of the things we've been talking about, you know, it's not very likely, or it's possible that we could experience drawdowns. And more importantly, we can experience, you know, severe drawdowns. And then it's more the duration of the drawdown. Like how long is that going to happen? And relative to your lifetime. And we don't need to even be American exceptionalist to see like historically how many times the US stock market in real terms has been deeply underwater or had really negative returns for, you know, 1 to 2 decades at a time. And that really can affect you if it lines up with your retirement or your peak earning years.
So first of all, I mean, there are definitely, and he alludes to this, there are some really good positives to the U.S. I mean, we're surrounded by oceans. We're the leader in technology right now in a time where technology is changing the whole world. There's a lot of good stuff. I mean, we've got democracy. There's a lot of positive things going on in the U.S. right now where you say, you know what, maybe things will continue to be good. But there's this idea that we're just better than everybody else, and it's just some given that like the U.S. is going to outperform everybody else, and that the U.S. is going to be the innovation center for the rest of the world. Like, I don't know that we can necessarily bank on that with like 100% certainty going forward, like a lot of people do.
100%. And this is where I know I mentioned him a minute ago, but like read the Peter Zion books. Like this is what this is all about. And you really start to think, wow, the US is in a really good place. But I want to cite the age old, I don't know who said this, but I think it's been around since the dawn of time. The winners write the history books. Like let's be clear. US exceptionalism is the winner, and it's in all the history books because we haven't had nary a true stumble in a long, long time. Our friend Jason Buck, he has this to say: after all, we are the absolute bosses of that whole theater and show in our minds. We even write the script. So always write positive dynamic scripts and show only the best movies for you on that screen, whether you are a volatility pimp or an efficient markets priest. The winners write the stories. We have to remember that US exceptionalism is a story of the past and doesn't necessarily precede what's coming next. We should open our minds to some of the things around us. And I know we're going to get to it in a minute, your favorite Japanese question too, but there's other scenarios to draw on here that aren't just the most winning story from, I don't know. I like connect this back to like brilliant people taking ice water baths in the morning, and I can be successful if I adopt their morning routines. It feels like the same logic to me. Do you get that sense too?
The whole Cliff Asness correlation versus causation situation. Yeah, obviously the ice bath is not leading you to be successful. Although maybe if you're willing to do it, you know, maybe you have other traits that are leading you to be successful because you'll sit in that thing. Although I won't sit in that thing. That's certainly not happening for me. So as we wrap up, obviously in my infinite wisdom, I decided let's use the word that's the most challenging to pronounce and also the most difficult concept. Let's go ahead and do that at the end. So here we're going to talk about ergodicity. So before we do that, I'm going to allow myself to recover from saying the word. And here's Jason talking about the concept.
So the way we like to think about it is this fancy word called ergodicity. But it's what we used to call sequencing risk, right? Is like your path is not that ensemble average path. So this is what I'm saying is not only the industry tend to, lie to us and treat our investments, as something that we can get rich off of instead of talking about them as our savings. The other one is they talk about those averages and that's what we started talking about is like, is the average path what you're going to return? And that's why they're looking at 7% CAGR or 10% nominal that people started to affix to these days is like, are you likely to get the average in the future, or is that the average of all the players? So to think about ergodicity, the real simple version is you're an ergodic system when the ensemble average is equal to the path average over time. The key word being time. And so a lot of times when we think about expected value and things, we're not adding in the addition of time. And throughout our lives, we compound through time. And so a lot of times when your individual path does not line up with the average path of the ensemble, that's a non-ergodic system. And unfortunately, markets, savings, compounding are non-ergodic systems. And so if we treat them like they're ergodic systems, we're likely to fall for a lot of things that can be really detrimental for our portfolio. To put it like a finer example on it, I think a good example would be is if 100 people were going to the casino. Let's say 100 people are going to Caesar's Palace, and let's say I have a game plan where they can make 50% returns. So I give them each $1,000. 100 people go in this casino. They're expected to make 50% returns or $500, but let's say one out of the 100 is going to totally blow up. So their expected value is $1,495 per player, 400, plus 495. That's great unexpected value. So the 100 people go to Caesars, one blows up, but it doesn't affect any of the other ones. Let's say player number 28 blows up, but 99 other players make, come back with $1,500. That's all good. That's the ensemble average. But let's say Jack goes to the casino and every day he uses this system to make 50% of his money. So he goes day one, puts down his $1,000, comes home with $1,500, goes back the next day, compounds at 50%, right? We get to day 27 and Jack has $56 million. Like, fantastic, right? You're on Zillow. You're on, you're looking at dream properties down in South Florida. Ken Griffin's going to be your neighbor. Everything's amazing, right? But then day 28 shows up and you blow up. Game over. You lose everything. There is no game. There's no day 29 in the casino now. Like, you are totally blown up. And that's the difference between your path ensemble through time as we compound versus the ensemble of a group. And that's what we're missing a lot of times is, what does our individual path look like over time, and what are the sequencing of those returns, and how do we compound them?
So I had to ask Claude about this because that's basically what I do. So Claude said, the key insight is that the average return across many parallel investments, space average, can be very different than the return of one investment over time average. So, and I think Jason was talking about this idea in the clip, like if you have a series of returns or series of things that can happen, and one of the things that can happen is you lose all of your money, and you're playing this out over time, it doesn't matter how well you do. Before you have that negative 100% return, at some point you're going to have the negative 100% return and you're done. So like thinking about averages and how they play out over time is the idea of this concept, but the word can, I think, be a little bit challenging for people.
The word's a little bit challenging. Hands down, best book on this is Luca Delana's book. So if you haven't checked out the book Ergodicity by Luca Delana, that is the read. I think most of us learned this word from Nassim Taleb 15, 20 years ago. Fooled by Randomness or Black Swan or something had this in it. The example that's always stuck in my head with this word that I love, and I use this in explaining sequence of returns risk all the time to this day, is if we have 100 coins and we flip all 100 coins at the exact same time, we're going to get to that average of a 50-50 split. And we're going to go, that's the average. When I flip 100 coins, it's a 50-50 heads and tails average. However, if I have all those coins lined up and I go down the line and I flip them one at a time, I'm going to have streaks. I'm going to have 10 heads in a row and then 14 tails in a row and whatever else as I work my way through. My sequence is not going to look like 50-50 that whole way through that stack. And this idea gets at, there's a difference between the sequence of experience of one path and the actual average that exists on the whole. I got at least one more quote from this book for you. In the book, a way that he kind of explains the ergodic theorem and the ergodic principle of sequence risk is he's talking about the risks that you take in life and how sometimes you can have a worse experience. You can be a worse sucker than others just because you're taking the wrong risks at the wrong time and you're getting unlucky on top of it. So he's telling this story and he says, I had been a bigger sucker than a square mark. All he loses is scratch. I had joined a club that suckered me behind proverbial poorhouse bars 5 times. So that journey along the way, Buck had to fail multiple times over. If you've heard him talk about the restaurant businesses, the real estate, the other stuff, life deals you some real blows, but you can turn those around and make lessons out of them. Because we compound through time, you just have to be careful about measuring yourself or your returns against those broader averages. Jack is a value investor. I mean, if nothing else, you've got to feel the ergodic theorem, like just in the reality of value returns on average over time versus in any 3-year span.
Yeah, no, that's right. And also going back to your coin example, like that's a really good way to think about it. So if basically I have a coin and I flip it heads or tails and I 10x my money on heads and I lose 100% of my money on tails, I don't care what the average of that is over time. If I keep flipping the coin, I'm going to run out of money, period. So that's the kind of idea of it's playing out over time. Like the average of those outcomes doesn't really matter to me. It blows me completely up as it plays out over time.
Yeah. If you end up in the proverbial poorhouse, like Buck in the story, 5 times over, bigger sucker than a square mark. Like that's the lesson to take away here. You don't want to be a bigger sucker and do that. I'd also relate it. It's the roulette math. If you're going to play roulette, the house always has that advantage. The only way to mathematically play roulette the correct way is take all the money you're willing to gamble, go up and just play once. Everything in on that one, because your odds only get worse after that first hit.
So I asked Claude, what does this mean for investors? Because that's very important. So Claude feels like the key takeaways here are portfolio diversification. By spreading investments across multiple assets, space averaging, you can reduce the impact of any single devastating loss. So yeah, I think that's the general idea of this. I mean, we don't have to get wrapped up in like crazy words and stuff, but that's the general idea. And this has huge implications for investors when you understand the concept.
Claude, basically the Ed Thorpe of AI investors, right?
Well, I mean, let's be honest here. Eventually, there's just going to be an AI version of me that's going to be far better than me sitting here doing this podcast. So I might as well start mixing Claude in. I want to get on his good side for when he does take over the world. I want him to feel good about me. I mean, I always say please and thank you when I ask Claude stuff in my queries. I think it's very, very important because when he does rule the world, I want him to be nice to me.
Be so nice to those robot overlords. You got to make sure you do that. I have a closing quote, so it's not from this book, but again, I highly suggest everybody should read this book, Iceberg Buck.
Just for the listeners here, this is Pimp by Iceberg Slim is the book we're looking at?
Yeah, well, Iceberg Buck, the story of my life, Pimp of Vol.
Okay.
Is the book.
So there's a slight revision on this other book that you have made.
I mean, I think, on his journey to discovering himself as a pirate, he explored a couple of personalities.
Okay.
And I applaud landing on the pirate thing. So I want to read this. This is from one of the later volumes from Airtight Willie and Me. He said, "This volume is dedicated to time. It gives us memories, fine wine and wrinkles. But the only thing worse than getting old is not getting old. So here's the time, dear readers, yours and mine. May you have many more wrinkles, a lot of fine wine, and memories to last 2 lifetimes." Jason Buck, thanks for all the clips, right?
Yeah, I'm sure he's just going to love this work we've put together based on his work. I'm sure he's going to consider like this the masterpiece of his career what we put together here.
This is the Dennis Rodman moment of his, Jordan ambitions, I am sure.
Hi guys, this is Justin again. Thanks so much for tuning into this episode. You can follow Jack on Twitter at @PracticalQuant. You can follow me on Twitter at JJCarbonneau and follow Matt on Twitter at @CultishCreative. If you found this discussion interesting and valuable, please subscribe in either iTunes or on YouTube, or leave a review or a comment. Also, if you have any ideas for topics you'd like us to cover in the future, please email us at excessreturnspod@gmail.com. We would like this to be a listener-driven podcast and would appreciate any suggestions. Thank you.
Jack Forehand is a principal at Validia Capital Management. Matt Ziegler is managing director at Sunpoint Investments. The opinions expressed in this podcast do not necessarily reflect the opinions of Validia Capital or Sunpoint Investments. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Validia Capital or Sunpoint Investments.